It starts with a single number one you never see. One insurers never show you, yet it quietly determines the cost of every mile you drive. Somewhere in North Carolina, a man opens his renewal notice expecting the same rate he's paid for years. Instead, the price has jumped by $600. No accident, no ticket, no change in coverage. Just a number shifting in a database. And across the country, in Idaho, a woman with the same driving record pays almost half his price. Not because she's luckier, but because the formula that calculates car insurance premiums in America doesn't treat everyone the same. It pulls from your driving habits, your credit behavior, your zip code, your job, even the way other drivers around you behave. It is one of the most complex financial algorithms in the country, one consumers never get to see. But today, you will. And once you understand how insurers calculate your rate, you'll know exactly how to lower it, challenge it, and protect yourself from the silent forces driving up the cost of simply owning a car in the United States. Because car insurance isn't priced like groceries or gas. It's priced like risk projected, predicted, and monetized. Every insurer in America uses a multi-layer risk model that evaluates not just who you are, but what your environment is, what your past suggests, and what your future might hold. An accident in your zip code, even one you didn't cause, can raise your rate. A surge in medical claims in your city can raise it again. Inflation hits repair shops, and suddenly your premium rises even if your driving hasn't changed at all. Many Americans believe insurers are punishing them individually, when in reality, they are reacting to national data trends in real time. But here's the truth. Once you understand the categories insurers use, your profile, your vehicle, your location, your history, you gain leverage. You're no longer a passive target of premium hikes. You're a strategist navigating a system that most people never learn to decode. Start with the factor that insurers weigh most heavily, your driving record. A clean record with no tickets or collisions tells insurers you're a low-risk investment. But the formula goes deeper. Insurers analyze not just accidents, but the severity of them. A small fender bender with no injuries may barely affect your rate, but a collision involving medical payouts triggers a far steeper increase. A single speeding ticket in some states raises premiums for 3 years. And the time of day you drive, late night, high accident hours, can influence telematics-based pricing. Consider a teacher in Virginia with a spotless record. She drives mostly during the day, avoids sudden braking, and maintains steady speed. Her insurer's algorithm rewards her, cutting her premium by 22% through behavioral tracking. Meanwhile, a driver in California commutes through high-accident corridors every morning. Even though he drives carefully, the environment raises his calculated risk. The formula is not emotional, it is mathematical. And understanding that math is the first step toward controlling it. But the algorithm goes further beyond behavior into personal financial history. In most U.S. states, credit score is one of the strongest predictors insurers use. They don't use it to judge your character. They use it because decades of data show a correlation between credit management and insurance claims. A driver with excellent credit may save $1,000 a year compared to someone with poor credit, even if both drive the same car with the same record. That's why a single missed payment in Tennessee can raise your premium more than a small speeding ticket in Oregon. Insurers also factor in job stability, length of residence, and whether you own or rent your home. These factors predict reliability in the algorithm. It feels unfair because it is impersonal, but once you understand the system, you can use it. Raising your credit score by just 30 points can lower your premium dramatically. Paying bills on time becomes a defensive strategy, not just financial responsibility. Your credit becomes armor. Then there is the element every driver underestimates: the vehicle itself. Insurers analyze repair cost, theft rate, safety technology, and claim history for your exact make and model. A newer SUV with advanced automatic braking may cost less to insure than a 10-year-old sedan with no modern safety systems. A car that thieves target in Chicago may be inexpensive to insure in Vermont. A luxury vehicle may have high repair costs, ballooning premiums, even if you rarely drive it. Even paint color affects claim data. A family in Florida buys a car with top-tier crash avoidance sensors and instantly saves hundreds because insurers know the vehicle reduces impact severity. Meanwhile, a young driver buys a cheap older car thinking insurance will be low, but ends up paying more because the car lacks modern protection and is more likely to be totaled in a crash. The vehicle you choose writes a chapter of your future premiums before you ever leave the lot. But the most misunderstood factor of all, the one that changes everything, is location. Your zip code can raise or lower your rate more than your driving history. If your neighborhood has high accident frequency, high theft, high litigation, or even simply congested roads, your premium rises. A peaceful suburb in Ohio may cost half of an urban street in New Jersey. Hospitals with high billing rates increase medical payout severity, which raises premiums region-wide. Even weather patterns, hail-prone states, hurricane zones, wildfire corridors shape the risk model. You may be a perfect driver living in a chaotic environment, and the formula reflects that, but you're not powerless. Drivers in high-risk areas save money not by moving but by adjusting deductibles, bundling policies, installing anti-theft devices, and comparing quotes annually. Because insurers weight locations differently. The cheapest insurer in Texas might be the most expensive in Maryland. The system isn't uniform, so your strategy shouldn't be either. And at the end of this journey, when the formulas, algorithms, risk scores, and data finally settle into clarity, one truth remains: car insurance premiums in America are not random. They are calculated, precise, and predictable if you know where to look. And once you understand the system, you stop living at the mercy of rising rates. You gain the power to question them, challenge them, reduce them. Protect yourself from unexpected costs, aggressive surcharges, and silent premium creep. Because knowledge is leverage, and leverage becomes savings. In a country where every mile carries cost, the smartest thing a driver can do is understand the price of risk before life forces them to learn it. Your premium is no longer a mystery. Now, it's a choice.